U.S. business activity slows. A look at the numbers. The U.S. economy, like a car stuck in traffic, is experiencing a bit of a slowdown. The S&P Global Report tells us that business activity, measured by the U.S. Composite PMI Output Index, dipped to 52.4 in January 2025. That's the lowest it's been in 9 months. A score above 50 still signals growth, but the declining number suggests a loss of momentum. Think of it as the economy still moving forward, but at a slower pace. This dip in business activity is a bit of a surprise. Many economists predicted continued growth. This slowdown has sparked debate. Some argue it's a temporary blip, others worry it might be a sign of trouble ahead. Services sector stumbles, the culprit behind the decline. So, what's dragging down the economy? The main culprit is the services sector. This sector, which includes everything from restaurants and hotels to healthcare and finance, has been hit by a perfect storm of challenges. Inflation has made consumers think twice about spending on non-essential services. Rising interest rates have made it more expensive for businesses to borrow money, and persistent labor shortages have made it difficult for service businesses to find and keep qualified workers. This slowdown in the services sector is a worrying sign. It suggests that consumers, who drive a significant portion of the U.S. economy, are becoming more cautious with their spending. This could have ripple effects throughout the economy if it continues. Manufacturing holds strong, a Trumpian triumph. While the services sector stumbles, the manufacturing sector is a different story. The services sector, which includes everything from retail to hospitality, has been hit hard by the pandemic and other economic challenges. Empty restaurant tables and stressed office workers are a common sight, reflecting the struggles faced by this part of the economy. Manufacturing activity, on the other hand, has actually picked up in recent months, defying expectations. Factories are buzzing with activity, and workers are busy assembling products. This resurgence is a surprising and welcome development in an otherwise challenging economic landscape. This sector, which produces goods like cars, airplanes, and machinery, has benefited from strong global demand and a weaker dollar. The demand for these products has remained robust, providing a lifeline for manufacturers. The weaker dollar has also made American goods more competitive on the global stage. Some analysts point to the policies of former President Trump as a contributing factor to the manufacturing sector's resilience. His administration's focus on boosting American manufacturing through various policies has had a lasting impact. His tariffs on Chinese goods, while controversial, may have provided some protection for American manufacturers. These tariffs were intended to level the playing field and reduce the trade deficit with China, and they appear to have had some positive effects on domestic manufacturing. His deregulation efforts may have also reduced costs and boosted investment in the sector. By cutting red tape and easing regulatory burdens, the Trump administration aimed to create a more business-friendly environment, encouraging companies to invest in manufacturing. However, it's important to note that the manufacturing sector is only a small part of the overall U.S. economy. Despite its recent strength, it cannot single-handedly drive economic growth. The sector's contribution, while significant, is limited in scope. The services sector is much larger, and its weakness is outweighing the strength in manufacturing. The health of the overall economy depends heavily on the services sector, and its struggles are a major concern. The road to recovery will require addressing the challenges faced by both sectors. The Fed's Balancing Act: Inflation and Interest Rates. The Federal Reserve, often referred to as the Fed, plays a crucial role in the U.S. economy. Its decisions on interest rates can influence everything from mortgage rates to the cost of borrowing for businesses. The Federal Reserve, the central bank of the United States, is facing a delicate balancing act. It must navigate the complex interplay between inflation and interest rates to maintain economic stability. Inflation, while cooling, remains above the Fed's target of 2%. This persistent inflation affects the purchasing power of consumers and can lead to higher costs for goods and services. The Fed has already raised interest rates several times in an attempt to tame inflation, but it risks tipping the economy into recession if it raises rates too aggressively. Higher interest rates can slow down economic growth by making borrowing more expensive. Adding to the complexity is the ongoing debate about the legacy of Trump's economic policies. These policies have had a lasting impact on the economy. influencing current economic conditions. His tax cuts, while boosting the economy in the short term, may have also contributed to inflation. The increased spending power from tax cuts can drive up demand, leading to higher prices. His trade wars may have disrupted supply chains and increased prices for consumers. Tariffs and trade barriers can lead to shortages and higher costs for imported goods. The Fed's next move is uncertain. It must carefully consider the potential consequences of its actions on both inflation and economic growth. It must weigh the risks of inflation against the risks of recession. Striking the right balance is crucial to avoid long-term economic damage. Its decisions will have a significant impact on the future of the U.S. economy. The Fed's actions will shape the economic landscape for years to come, influencing everything from job growth to consumer confidence. Section 5. Passing the buck. Businesses grapple with rising costs. Businesses across the United States are facing a cost crunch. Input costs, the prices businesses pay for raw materials, energy, and labor, have been rising steadily. This is partly due to inflation, but also due to supply chain disruptions and labor shortages. Many businesses have been forced to raise prices to pass these higher costs on to consumers. This is adding to inflationary pressures and squeezing household budgets. Consumers are feeling the pinch, especially for essential goods and services. This cost-price spiral is a concern for the economy. If businesses continue to raise prices and consumers cut back on spending, it could lead to a recession. Section 6. Help wanted. Hiring surges amid labor shortages. Despite the economic slowdown, the labor market remains strong. Businesses are still hiring at a rapid pace, and the unemployment rate is near historic lows. However, there are significant labor shortages in many industries, particularly in healthcare, manufacturing, and transportation. The reasons for these labor shortages are complex. They include an aging workforce, a decline in immigration, and a mismatch between the skills workers have and the skills employers need. These shortages are making it difficult for businesses to find qualified workers, which is constraining growth and contributing to wage inflation. The labor market is a key indicator of economic health. While the current strength is encouraging, the persistent labor shortages pose a challenge for businesses and the economy as a whole. Section 7. A tale of two sectors: manufacturing versus services. The U.S. economy is a tale of two sectors: manufacturing and services. As we've seen, manufacturing is performing well, while services are struggling. This divergence highlights the uneven nature of the current economic recovery. The manufacturing sector is benefiting from strong global demand and a weaker dollar, which makes U.S. goods more competitive overseas. The services sector, on the other hand, is more exposed to domestic economic conditions, such as inflation and interest rates. This divergence between manufacturing and services is unlikely to last forever. As the global economy slows and the Federal Reserve continues to raise interest rates, manufacturing growth is likely to moderate. The question is whether the services sector can regain its footing and drive the economy forward. Section 8. Cautious optimism. Businesses look ahead to 2026. Despite the challenges facing the U.S. economy, businesses remain cautiously optimistic about the future. Many businesses are still planning to hire and invest in the coming year. They are hoping that inflation will continue to cool, that the Federal Reserve will be able to engineer a soft landing for the economy, and that the labor market will remain strong. However, there are also significant risks on the horizon. The war in Ukraine, rising geopolitical tensions, and the ongoing threat of climate change all have the potential to disrupt the economy. Businesses are navigating a complex and uncertain environment. Their ability to adapt to changing conditions and overcome challenges will determine the course of the U.S. economy in 2026 and beyond. Section 9. Conclusion. Navigating uncertainty in the new year. The U.S. economy is at a crossroads. As we step into the new year, the landscape is filled with both challenges and opportunities. Businesses and individuals alike are grappling with the uncertainties that lie ahead. The slowdown in business activity, driven by weakness in the services sector, is a cause for concern. Many companies are facing unprecedented challenges, from supply chain disruptions to changing consumer behaviors. However, the strength in manufacturing, the robust labor market, and the cautious optimism of businesses offer some hope. Manufacturing has shown resilience, adapting to new demands and innovations. The cautious optimism of businesses, coupled with strategic planning and innovation, provides a beacon of hope. Companies are finding new ways to thrive, leveraging technology and creative solutions. The Federal Reserve's actions in the coming months will be crucial in determining whether the U.S. can avoid a recession and achieve a soft landing. Their policies will play a significant role in stabilizing the economy and fostering growth. The road ahead is uncertain, filled with twists and turns. Businesses must remain agile and adaptable, ready to pivot as new challenges and opportunities arise. But one thing is clear: the U.S. economy is resilient and adaptable. It has a history of overcoming adversity and emerging stronger. It has weathered many storms in the past, from financial crises to global pandemics. Each challenge has been met with determination and innovation, and it will undoubtedly weather this one as well. The spirit of resilience and the drive to rebuild and innovate will guide us through. The key will be for policymakers, businesses, and consumers to work together to navigate the challenges and seize the opportunities that lie ahead. Collaboration and unity will be essential in forging a path to a prosperous future.